Imagine you could take a financial X-ray, capturing a company's financial well-being in a single frame. That's what a balance sheet does. It shows assets, liabilities, and equity at a specific point in time. Think of it as a financial report card. Investors gain insights into a company's financial strength. Does the company have enough assets to cover its debts? What is the composition of its assets and liabilities? How much has been invested by owners? Understanding the balance sheet is essential for informed decision-making. The balance sheet is structured around a fundamental accounting equation. Assets equals liabilities plus equity. This simple equation underpins the entire concept of the balance sheet. A company's resources, or assets, are financed by borrowing money, called liabilities, or owner contributions, known as equity. Assets include tangible items like cash, inventory, and property, as well as intangible assets, such as patents. Liabilities represent what a company owes, like accounts payable and bank loans. Equity is the portion of the company's assets that belongs to its owners. Assets are broadly categorized into current assets and non-current assets. Current assets are those that are expected to be converted into cash or used up within 1 year. Common examples include cash, the most liquid asset, representing the cash on hand and in bank accounts, accounts receivable, which is money owed to the company by customers for goods or services provided on credit. Inventory, which includes goods held for sale in the ordinary course of business. Non-current assets, also known as long-term assets, are those that are expected to provide economic benefits for more than 1 year. These typically include property, plant and equipment, or PP&E, which are tangible assets such as land, buildings, machinery and vehicles. Intangible assets, which are non-physical assets like patents, copyrights, trademarks and goodwill. Understanding the composition of a company's assets is crucial for assessing its liquidity and operational efficiency. Section 4. Unraveling liabilities, what you owe. Similar to assets, liabilities are classified as current liabilities and non-current liabilities. Current liabilities are obligations that are due within 1 year. Some common examples are accounts payable, short-term obligations owed to suppliers for goods or services purchased on credit, salaries, payable wages, and salaries owed to employees, short-term debt, borrowings that are due for repayment within 1 year. Non-current liabilities, also known as long-term liabilities, are obligations that are due after 1 year. These may include long-term debt, bank loans, bonds, and other borrowings that have maturities exceeding 1 year. Deferred revenue payments received in advance for goods or services that are yet to be delivered or rendered. Analyzing a company's liabilities helps evaluate its financial risk and debt management practices. Section 5. Equity, your share of the pie. Equity represents the owner's claim on the assets of a company. It's the residual interest after deducting liabilities from assets. Equity comprises several components. Common stock represents the basic ownership units of a corporation. Preferred stock, a type of stock that typically carries preferential rights over common stock, such as dividend payments and claims on assets in the event of liquidation. Retained earnings, the accumulated profits of a company that have been reinvested back into the business. Treasury stock, shares of a company's own stock that have been repurchased from the open market. Examining a company's equity section provides insights into its capital structure, ownership distribution, and profitability over time. Section 6. The power of the balance sheet. Financial health at a glance. The balance sheet is a powerful tool for assessing a company's financial health. It provides a comprehensive view of a company's assets, liabilities, and equity, allowing stakeholders to evaluate its liquidity, solvency, and capital structure. By analyzing balance sheet ratios and trends, investors and analysts can gain insights into a company's liquidity, the ability to meet short-term obligations, solvency, the ability to meet long-term obligations, financial leverage, the extent to which a company uses debt financing, asset efficiency, how effectively a company is utilizing its assets. Understanding the balance sheet is not just for financial experts, it's an essential tool for anyone looking to make informed financial decisions, whether it's investing in stocks, extending credit, or simply understanding the financial health of a company.